Hi guys, welcome to the Tools Rand Swiss Weekly Roundup. This week we're going to discuss a number of factors, and I think we're going to pay special attention to the possibility of recession in the US. I wrote an article about it earlier this week, and I think it's quite an interesting topic to discuss with you guys. Okay, let's just start off from the scratch. We had some unemployment numbers coming from South Africa today, this week. Unemployment rose again. The unofficial rate is above basically, I think 46%. The official rate is still above 35%. Again, focused mainly on younger people, focused mainly on previously disadvantaged groups. And it's obviously a huge problem for South Africa. Not having enough jobs being created to absorb the workforce is one of the reasons we're seeing the stuff that's happening, for instance, in Soweto recently with the anti-immigrant movements. It's very, very dangerous for a country to have this kind of thing occur because what tends to happen is you tend to have a large restive population who doesn't basically have, a pathway towards the future, making things such as rioting, making things such as anti-immigrant or xenophobia sentiments more likely, making radical parties more likely to be elected. So this is obviously a very bad number. We would need to grow probably in excess of 5% a year as a country to start to make a dent on this unemployment rate. At the moment, we are creating jobs. We are having more people entering the workforce, however, than the jobs being created, and that is the main issue. Don't just need to basically create enough jobs to basically get the people that's getting into the workforce absorbed. We create more jobs to absorb the people that are not working right now, that enter the workforce maybe in the last few years or so. In addition to that, we also need to create more growth beyond that, because the current jobs we have in this country are just too low paying to basically satisfy the needs and the wants of the population. So as you can see, a couple percent a year is not going to be enough to just satisfy that. Yeah, even 5% probably is not going to be enough to do something about that at a sufficiently fast pace to basically make a difference in your lifetime. We probably need to be seeing some kind of growth rates near China, India levels, the 7-8%, ideally to get that kind of growth under control. But I think, quite frankly, aiming for at least 5 is essential as a minimum for what's happening with the unemployment rate. Next, the US made a maneuver in the oil markets this week. They released about 180 million barrels of oil. To give you an idea of what this means, basically, it's going to be about 1 million barrels a day for 6 months, so 180 days. It's important. It did make a difference in the oil markets. We saw oil prices drop quite substantially on that news. But however, I don't think it's sufficient. To give you an idea of what the US makes, it makes about 12 million barrels a day. So this is basically 8% of what the normal daily production is being released. The US growth in terms of daily production has been kind of stymied for whatever reason. People mentioned the fact that the new administration was against oil exploration, but others point to the fact that very little actual law has been put into place that would have stymied that oil exploration or the oil extraction. So it's a case of maybe perhaps people are just afraid because of sentiment. It would also be because they've been burnt in the past. Last few times oil prices have risen, production increased, oil prices fell. That increased production suddenly became unprofitable. So it could be a case of this time around, prices increase, you're making some oil, just get the profits and distribute to your investors, as opposed to trying reinvesting and trying to ride the wave higher. Update on Ukraine. Nothing much is happening. The Russians have pulled back from Kiev, or Kyiv, how are we going to pronounce that nowadays? Apparently the politically correct way to do it is Kyiv. Kiev is the Russian pronunciation, so let's just say Kyiv. They pulled back from Kyiv. There's some dispute as to whether or not this was part of some grand plan, or whether or not they've been basically beaten back. I think it's about a 50-50 kind of thing here. I think they weren't really serious about getting Kyiv. They did not really focus on it as a key aspect of their plans. What they wanted to do was get that land bridge over to Crimea, consolidate the stuff in the east, and it could have been that the Kyiv movement was almost a feint where they put some troops up there, and because it was the most important part of the Ukraine to the Ukrainians put excess forces there just to basically protect their capital city, taking forces away from the east, allowing for the easier conquering of the east. At the same time, they weren't doing just a pure fake maneuver, the Russians, they had some troops there. There were paratroopers that were slaughtered when they were dropped into the area. There was a number of losses of Russian troops in and around that Kyiv battlefield, and that was basically obviously not a fake. So I think it was a case of where they We had a strong kind of move towards it, not totally committed. And if they would have taken it, if they had the chance, they did not get the ability, or didn't have the ability to basically move through that maneuver. So they kind of fell back to a plan B, which means, pull back from Kyiv once you've consolidated your hold over the east. And as promised, here's our little kind of talk about the recession, problems that might be occurring in the US. In the last few months, last couple of years, so we've seen inflation tick up in the US significantly. This was probably due to the supply chain issues around the pandemic, increased demand because people were given these massive stimulus checks. Also, the fact that people were staying at home, they could not go out. They still often have the same incomes they had before the pandemic started, and so they were at home, same amount of money. They couldn't go out, they couldn't buy services. What do you buy instead? You buy goods. Okay, you can't go out and go partying with your friends. You can't go and spend money at the theater. You can't go on holiday. That money is still available. Maybe buy a new PS5. Maybe buy a new car. Maybe buy something to do with your house. And that all drove inflation higher in the US. So the inflation rate in the US basically at the last reading was just under 8% a year. Okay, year on year. Now, historically, this is a very high level. The target for the US is 2. Okay, so this is significantly higher. To give you an idea, we in South Africa, our target is under 6. To get like an 8 relative to 2, it's 24%. And imagine 24% interest rates, inflation rate in South Africa. Interest rates in the US are rising, but they are not rising to 8%. Even the most extreme, outlooks are there looking at 4% in a few years' time. That's still going to be basically below 8%, which means that real interest rates, the interest rate minus the inflation rate, is going to be negative. So if you have cash and put it in the bank, that money is worth less when it comes out than when you put it in, because the interest you get is less than the inflation rate, so the money is losing value faster than you're earning interest on it. When that occurs, what you don't do is save money anymore. Why? Because if you put money to be saved, you're going to lose it. So you're going to invest in something, so you're going to buy stuff. You're going to buy stuff that basically will maintain its value. When you buy stuff, you increase demand for things, that means increasing the inflation rate. That is the kind of cycle we're in right now. Historically, what's happened in the US is that when you do have the unemployment rate below 4%, which is right now, our run rate is 3.8 or something, and you have the inflation rate above 4%, is like I said, close to 8% now, you generally do have a recession in the next couple of years. There's a 50% chance thereabout of getting it in the next year, and there's a 75% chance it happens in the next 2 years. So the current inflation unemployment dynamic means that we probably have a 75% chance of something happening. Now, where do you get these 1970s? The 1970s was also a period in which we had, what's called stagflation, where you had high inflation, you had low growth, and the economy in the US really had a lot of trouble, and globally as well. But people often also point to the fact that they also had the energy crisis, which is when the Saudis and OPEC basically kind of turned off the taps on the West because of the Israeli war. So there was a couple other things that happened at that time that were kind of like bad luck events. This time our bad luck event is the Ukraine-Russia situation, as well as, by the way, increased lockdowns in China. The Chinese are locking down huge swathes of the population, and apparently they have not really vaccinated the majority of the elderly population. Something like under 50% of the elderly population is vaccinated. It's somewhere around 40 to 50%, but it's still, not 90% like you would expect from a place like China. And what that means is that with Omicron going out there, with Omicron spreading like it is, it's really devastating, wherever it goes. The problem is that China has a no COVID policy, a zero COVID policy. For them, any COVID case is unacceptable. In the West and South Africa, for instance, in contrast, we've come to a point right now, we can't accept there's going to be a certain amount of cases. We're not going to close on a city just because of 1 or 2 cases or a couple of dozen or even a couple of 100 cases of COVID appearing. China is doing that. They're shutting down the bigger cities. So you have the China situation, the lockdowns, plus the Ukraine situation, on top of what was already a tough inflation environment. And we are looking at a really troublesome next year or so when it comes to the inflation rate, not just in the US, but elsewhere in the world as well. The Fed may be forced to go off and raise interest rates to fight this. That may very likely cause a recession in the US. that is something I think that we need to basically start pricing into our models, pricing into our investment decisions. A 75% chance right now, as it seems, of a recession in the US within the next 24 months. It sounds a bit dire and a bit crazy, but yeah, that's what you need to be looking at least as a consideration. So I hope you guys were informed by this week's little talk, and I'll speak to you guys again next week. Cheers.